Today, we're going deep, really deep, into a company that's hiding in plain sight, Dr. Lal PathLabs. We're going to pull apart its business model, stress test its financials, and most importantly, figure out what could actually break this company. All right, let's get into it.
You know, this one quote really says it all. We have to stop thinking of Dr. Lal as just another lab. It's not. It's critical healthcare infrastructure. And that distinction is everything. So over the next few minutes, we're going to unpack exactly why that is. We'll look at the market situation, the company's specific actions, and then we'll get to the fun part, the kill switches that could bring the whole thing down. So here's the common mistake people make. They think, oh, it's just blood testing. How hard can it be? Anyone can open a lab. But if that were true, you wouldn't see a business consistently making over 20% on the capital it invests. The reality? This is a brutal game of logistics, quality control, and, above all, trust. Think about it. A doctor's entire reputation is on the line with every single test result. They're not going to send their patients to some random place. They send them to the name they trust. And that trust, built over decades, well, that's the real moat.
Okay, so to really get Dr. Lal's strategy, we first need to understand the world they operate in. Let's lay out the situation on the ground.
Now this is where it gets really interesting. Look at this market. It is incredibly fragmented. About 65% of all diagnostic tests are done by small, local, unorganized labs. And what that creates is this massive long-term tailwind for the big organized players like Dr. Lal. Because as the country develops, as patients demand better quality, that market share is naturally going to shift over to the trusted national brands. It's almost inevitable.
And this right here, this is the economic engine that makes it all work for the big guys. Diagnostics is a business of what we call operating leverage. You spend a ton of money up front on these huge automated central labs. But once they're up and running, the cost to process one more blood sample is tiny. So the more tests you run, the wider your profit margins get. It's a scale game that the little local labs just can't compete in.
So knowing what the market looks like, let's look at Dr. Lal's specific playbook. How do they actually go about winning? Well, it's all about building that infrastructure of trust piece by piece.
And their model is it's brilliant. It's not about building a giant lab in every single city. No, that's way too expensive. Instead, they use this asset-light hub-and-spoke system. You have one massive central lab doing all the complicated stuff. That's fed by smaller regional labs, which are then fed by thousands of tiny collection centers where you and I actually go. This creates this incredible network density, which means they can collect a sample and get the result back faster and more efficiently than anyone else. That speed is a huge deal for doctors and patients.
Now let's talk about where the real money is made. You've got two channels here, B2B, which is selling the hospitals, and B2C, which is patients like us just walking in. B2B, that's a low-margin, high-volume game. But B2C is totally different. It's driven by the brand, by that trust we talked about, and it comes with much, much higher margins. The fact that Dr. Lal has such a big chunk of its business in B2C is what really protects its profitability from the cutthroat price wars you see in the hospital segment.
Okay. So the story sounds great, right? Asset light, high leverage, strong brand. But does it actually show up in the numbers? This is where the rubber meets the road. And you're going to want to stick around because right after this, we're going to talk about those kill switches, the things that could absolutely torpedo this entire investment case.
All right, let's walk through the numbers because they have to back up the story. First, let's talk profitability. Return on equity and return on capital employed have both been consistently over 20%. That is the signature of a high-quality, efficient business. Then growth. Sales and profits have grown at a really healthy clip over the last few years, which shows the business is steadily expanding. Now, because of all this quality, the stock does trade at a premium PE ratio. The market knows this is a solid, defensive business, and it's willing to pay up for that consistency.
So a fair question to ask is, hey, was all this performance just because of COVID? And this slide answers that perfectly. You can see their return on capital was already strong, well above 20% even before the pandemic hit. Sure, it spiked with all the COVID testing, and then it came back down, but that wasn't a sign of weakness. It was just things getting back to normal. The key thing to see here is that even after COVID, profitability has settled in at a very healthy level. This proves that the high returns are a core feature of the business itself, not some one-time fluke.
The financial health gets even better when you look at the balance sheet. They have almost no debt. In fact, they're a net cash company, which means they have more cash in the bank than all their debt combined. And look at the cash flow. Cash from operations almost perfectly matches their reported earnings, or EBITDA. When you see that kind of alignment, it tells you their profits are real. They're turning into actual cash. Throw in the fact that they don't need much working capital to run the business, and what you've got is a financially conservative, cash-printing machine.
And one last thing on this, the company is still promoter-led. The founding family holds about 55% of the shares. That gives you a lot of confidence that they're thinking about the long-term health of the business, not just the next quarter's earnings report. All right, now for what I think is the most important part of any investment analysis. We've talked about all the good stuff. Now let's try to break it. Let's try to kill the thesis. What are the specific things that could happen that would permanently destroy value? These are the kill switches.
Kill switch number 1, a brutal, all-out price war. If these online aggregators or some new deep-pocketed competitor manages to turn diagnostics into a commodity where price is the only thing that matters, well, that brand premium Dr. Lal has built just vanishes. That would crush their margins and their returns. It's a real threat we have to watch.
Kill switch number 2 is regulation. This is the big external risk. If the government, for whatever reason, decides to put a cap on the prices of common tests, that would directly hammer the profits of every single private player, including Dr. Lal. It's a constant risk you have to live with when you're investing in healthcare.
And kill switch number 3 is a self-inflicted wound, a really bad acquisition. The danger here is that management gets impatient for growth, overpays for a bunch of smaller labs, and then completely fails to integrate them properly. That is the fastest way to destroy the high returns that make this business so attractive in the first place. So far, they've been disciplined, but we have to watch this like a hawk. And beyond those big 3, we're also keeping an eye on a few other things. Hospitals trying to build their own labs, new technology like at-home testing becoming more popular, and of course, the ultimate nightmare for a trust-based brand, a single, major screw-up with quality control that wipes out decades of credibility overnight.
So, after looking at the market, the strategy, the numbers, and all the things that could go wrong, we can finally land on a verdict. We can resolve that initial question of what kind of business this really is.
Look, the core investment case really just boils down to these 4 things. 1, it's a high-return, asset-light business. 2, it has a powerful brand and network that brings in high-margin customers. 3, it's riding that massive long-term wave of healthcare formalization. And 4, it's run by a disciplined team with a fortress balance sheet. That right there is the classic definition of a defensive compounder.
From a professional investor's point of view, this isn't something you trade in and out of. This is a core, long-term position. The strategy is to build a stake, hold it for many, many years, and use any market panic as a chance to buy more, all while never, ever taking your eye off those kill switch risks we just talked about.
And that kind of leaves us with one final question to think about. In a world that is completely obsessed with disruption and the next big thing, maybe, just maybe, the most durable long-term growth is found in something a lot more boring: relentless, day in, day out discipline.